So today our topic for this block 4 is amalgamation of companies accounting treatment. So in the last class we have already discussed what is amalgamation, what is absorption and what is reconstruction. So today now we have to check the accounting entries that if the two companies are amalgamating with each other, then what kind of accounting entries we need to record, and how we can make a balance in these entries, and how we can consolidate the accounts of these two companies. So first of all we need to discuss about the objective, then we need to discuss the introduction, then accounting entries in the books of transferee, that is purchasing company, and the accounting entries in the books of transferor company, and then we need to prepare the balance sheet in the books of transferee company. There are two methods which we use basically. First one is pulling off interest method, second one is purchase consideration method. So, first of all, we need to discuss the objectives, that we need to understand the accounting entries in the case of amalgamation of companies. Then we need to pass these accounting entries in the books of transferee company, then accounting entries in the books of transferor company. Then we need to prepare the balance sheet under pulling of interest method and purchase consideration method in the books of transferee company. So basically when we introduce this particular unit, so there are two or more companies doing similar business going to liquidation, and a new company is formed to take over their business. So it is known as amalgamation. For example, if a new company Z Limited is formed to take over X Limited and Y Limited, which are existing companies. So it is an example of amalgamation. In the above, X Limited and Y Limited are transfer company and Z Limited is transferee company. The transfer company ceases to function as a separate entity. So all accounts given in its balance sheet must be closed. Amalgamation is of two types, that is amalgamation in the nature of merger or amalgamation in the nature of purchase. So, first of all, we see that the accounting entries in the books of transferee company. So, the accounting entries in the books of transferee company will be different in both the types of amalgamation. There are two methods in this. First one is the pulling of interest method. This method is applicable in case of amalgamation in the nature of merger. So in this case, the amalgamation is accounted for as if separate business of amalgamated companies are intended to be carried on by the transferor company. That is when only minimum changes are made in aggregating the individual financial statement of the transferor company. The following factors are considered in this method. First of all, the asset, liabilities, and reserve of the transferor company are recorded by the transferee company at their existing carrying amount and in the same form as at the date of amalgamation. The balance of P&L account, that is profit and loss account, of the transferor company is aggregated with the balance of the transferee company or transferred to general reserve. The identity of the reserve is preserved and they are shown in the balance sheet of the transferee company in the same form in which they appeared in the balance sheet of the transfer company. Next one is the difference between the amount recorded as share capital issued plus any additional consideration in the form of cash on the one hand, and the amount of share capital of the transfer company on the other hand is adjusted in reserve or profit or and loss as the case may be. So first of all, there are some general entries which we need to make in the books of transferee company in case of amalgamation in the nature of merger. So first of all, we are seeing the case of the merger method. So for recording the purchase consideration, we need to pass the general entry is business purchase account debit to liquidator of transfer company, and the amount will be shown of purchase consideration, and the narration of this entry will be being purchase consideration become due. So if debit balance of total of asset exceed the total of the liability and purchase consideration, then the difference is adjusted in general reserve, being the balancing figure for recording the asset and liabilities taken over. So that will be passed as a sundry asset account debit to sundry liability account, to provision for doubtful debt account, to profit and loss account, to reserve account, to business purchase account. And all the amount which is come in this entry, that will be the book value. And in the case of reserve account, so the amount will be adjusted value, and in case of business purchase, the amount will be purchase consideration. So, whereas if debit balance of total of asset are less as compared to the total of liability side, then the difference is adjusted in debit balance of profit and loss account, being the balancing figure. So, the amount or entry will be sundry asset account debit to profit and loss account debit to sundry liability account to provision for doubtful debt account to business purchase account. So the amount which will be come in sundry asset, that will be the book value. In the case of P&L account, that will be the balancing figure. Then sundry liability, that will be the book value, and the business purchase account, that will be comes under purchase consideration. Next entry will be on discharge of purchase consideration, liquidator of the transfer company account debit to share capital account, to security premium account, and to bank account. So in the case of liquidator of the transfer company, purchase consideration amount will be shown, to share capital account with face value will be shown, to security premium account, that will be with premium amount will be shown. So next one is if the transferee company bears the liquidation expense, that entry will be passed as general reserve account debit to bank account. And next one is for the formation expenses of the transferee company, that will be entry will be passed preliminary expenses account debit to bank account. Our second entry will be purchase method. This method is adopted when the amalgamation is in the nature of purchase. So the asset and liabilities of the transferor company are incorporated in the books of the transferee company either at the book value or at the revised price. Next one is general reserve, capital reserve, or any other reserve of the transferee company other than the statutory reserve should not be included in the books of the financial statement of the transferee company. In order to preserve the identity of the statutory reserve of the transferee company, such as investment allowance reserve, development allowance reserve, export profit reserve, etc., in the books of transferee company for legal compliance by debiting amalgamation adjustment account and crediting the statutory reserve account. If the purchase consideration exceed the value of net asset, such as excess is called as goodwill and is debited in the books of transferee company. If the purchase consideration is lower than the value of net asset acquired, the difference is credited to capital reserve, being capital profit. So here are some general entries that will be passed in the books of transferee company in the case of amalgamation in the nature of purchase. So first of all, for recording the purchase consideration, business purchase account debit to liquidator of transferee company, and the amount will be shown as the amount of purchase consideration. Next one is for recording the asset and liabilities taken over if total of debit exceed the total of credit. So that will be sundry asset account debit at revised value, goodwill account debit, that will be the balancing figure, to sundry liability revised value, to business purchase, that will be purchase consideration. For recording the asset and liabilities taken over if total of credit exceed the total of debit, so that will be the sundry asset account debit at revised values, to sundry liability account shown as revised value, to business purchase account, that will be purchase consideration, to capital reserve account, that will be balancing figure. On discharge of purchase consideration, liquidator of transfer company account debit, that will be purchase consideration, to share capital account with face value, to security premium with premium amount, to bank account, and the narration will be being purchase consideration satisfied. Next one is if the transferee company bears the liquidation expenses, so the entry will be goodwill account debit to bank account as the expenses paid by transferee company. Next one is for the formation expenses of the transferee company, preliminary expenses account debit to bank account, that will be the expenses paid by transferee company. Next one is to record the statutory reserve of the transferee company, amalgamation adjusted account debit to statutory reserve, and that one, the record of statutory reserve of transferee company by transferee company. So now we need to know the accounting entries in the books of transfer company, that how we can basically do the accounting entries in the books of transferor company. So whenever we are amalgamating the two companies, one is transferee company and one is transferor company, we need to enter the accounting entries in both of the accounts. And in the case of transferee company, we have already seen that how we can pass the necessary general entries in the books of transferee company account. Now we need to check the accounting entries in the case of transfer company. So like this, first of all, the accounting entries which need to be passed in the transfer company are mostly similar, as we have already studied in the case of transferee company. If we are using the method of merger or purchase, in both the cases the entry will be almost same. Now all the assets which are taken over by the transferee company are transferred to realization account at their book values. Book value means when the amount which is shown in the balance sheet is same the amount which we are showing in the entry, that will be known as the book value amount. Means the assets which are actually amounted or actually amounted in the present time, that will be known as the book value amount. So the entry will be passed realization account debit to sundry asset individually. Individually here means if the we have multiple assets, like we have building, so we write realization account debit to building, to plant, to machinery, to stock, to cash, to bank. So this kind we need to write this entry in the case of transfer company. So here are some points which we need to be noted in this particular entry, that if the transferee company does not take over cash and bank balance, these should not be transferred to realization account. Second one is fictitious assets should not be transferred to the realization account. Third one is goodwill and other intangible assets should be transferred to the realization account. Fourth one is provisions should be transferred to the credit side of the realization account. So all liabilities which are taken over by the transferee company are transferred to realization account at their book values. So the entry which we need to pass for the liabilities, that will be liability account debit to realization account. So here are some points which we need to figure out for this entry, that the outside liability including debentures shall be presumed to be taken over and then discharged by the transferee company. Debentures and other outside liabilities are transferred to credit side of realization account. Second one is accumulated profit should not be transferred to the realization account. Third one is if any fund denotes liability, it should be transferred to realization account. So our next entry will be passed for the purchase consideration to be paid by the transferee company. So the entry which will be passed is transferee company account debit to realization account, and the narration will be being purchase consideration agreed upon. Our next entry will be for recording purchase consideration. So the entry will be bank account debit, shares in transferee company account debit to transferor company. Next one is on sale of asset not taken over the transferee company. So in this case, bank account debit, realization account debit to asset account, and the narration will be passed that cash recovered from the sale of asset. Next one is if some liability is not taken over by the transferee company. So the entry will be liability account debit, realization account debit if the excess payment is made, and then to bank account. If there is no excess payment is made, so the entry will be liability account debit to bank account. Next one is payment of liquidation expenses borne by the transferor company. So the entry will be realization account debit to bank account. Next one is for payment of liquidation expenses when borne by the transferor company and later on reimbursed by transferee company. So the entry will be transferee company account debit to bank account. Next one is bank account debit to transferee company account. Post entry we will pass for the expenses of liquidation to be met by transferee company, and the second entry which we pass, that will be the being liquidation expenses received from transferee company. Next one is for payment of liquidation expenses to transferee company, then no entry will be passed. Next, in the case of realization expenses should never be included in the purchase consideration. Next one is for paying the liability not shown in the balance sheet. That means if there is some kind of liability which a company has been paid but not shown in the balance sheet, then realization account debit to bank account. Next one is if realization account shows the profit, so the entry will be realization account debit to equity shareholder account. Next one is if realization account shows the loss, then equity shareholder account debit to realization account. Next one is entitlement of equity shareholders. So the entry will be equity share capital account, reserve account, contingency fund account debit, dividend equalization fund debit, workman compensation fund account debit, insurance fund account debit, profit and loss account debit to equity shareholder account. Next entry will be equity shareholder claim is reduced by debit balances of P&L account and fictitious asset. So the equity shareholder account debit to profit and loss account to preliminary expenses account to discount on issue of share account. This entry will be passed. Next one is for paying the equity shareholders, then equity shareholder account debit to bank account to shares in transferee company account. being the payment to equity shareholders. Now we need to see the balance sheet of two companies and how we can consolidate this particular balance sheet in one. So first of all, the method which we are using, that will be the pulling of interest method. So the illustration which is given to us is the Sun Limited and the Moon Limited are in the business of similar nature, decided to amalgamate, and a new company is formed called Star Limited, who took over the assets and liabilities of both the companies. So the following are the balance sheet. So the balance sheet as on 31st March 2021, we have the liabilities of Sun Limited and Moon Limited, and we have all the asset of Sun Limited and Moon Limited. So now, assuming that assets realize at their book value, what amount each company will get, prepare the balance sheet after amalgamation and general entries in the books of Star Limited. So the calculation of purchase limited, first of all, we need to do that. So the asset taken over by the Star Limited will be goodwill, freehold premises, plant and machinery, stock, sundry debtors, cash at bank. So the total of Sun Limited will be 83,000 and the total of Moon Limited will be 50,000. Then we deduct the liabilities. That will be the outside liability taken over by Star Limited. So that will be first of all the sundry creditors, and when we deduct the liability from the asset, we will get the purchase consideration, and 80,000 for Sun Limited and Moon and 50,000 for Moon Limited. Now we need to pass the general entry. So first of all, the S Limited, the general entries in the books of Star Limited, that will be the transferee company. First of all, we need to do that business purchase account debit to, first of all, in the case of business purchase, the amount will be 1,30,000. So if you see that 80,000 plus 50,000, that will be the purchase consideration, and the amount will be at 80,000 and 50,000. So the amount will be 1,30,000. To liquidator of Sun Limited, that will be 80,000, and to liquidator 2 of Moon Limited, that will be 50,000. Then second entry we will pass for the assets, that will be the goodwill account debit, freehold premises account debit, plant and machinery, stock, sundry debtor account debit, bank account debit, to sundry creditor account, and to purchase business purchase account. So basically we add both the amounts of the asset of Sun Limited and Moon Limited, then we post it to the Star Limited. Our third entry which we need to pass, that will be liquidator of Sun Limited account debit, liquidator of Moon Limited account debit, to share capital account, that will be the total amount of business purchase of rupees 1,30,000. Now, balance sheet of Star Limited after amalgamation. So, after amalgamation, there is only for the Star Limited balance sheet. So, at the liability side, share capital, issued capital, that will be 13,000 shares of rupees 10 each, that will be 1,30,000. Then reserve and surplus, that will be current liabilities, that will be current credit, sorry, sundry creditors, 5,000. Then in the asset side, fixed asset, we have goodwill 50,000, freehold premises 10,000, plant and machinery 31,750, sorry, 31,750. Then we have the current assets, stock we have 27,550, debtors we have 13,500, then cash at bank we have 2,200, and the total of both the side will be 1,35,000. They give us some kind of note that in the case of amalgamation, in the nature of merger, since all the five conditions given in the accounting standard 14 are fulfilled, then there is no balancing figure in the form of general reserve or profit and loss account as verified under. How we can verify this? We can make this kind of, that will be the purchase consideration 1,30,000. Then we deduct the share capital of Sun Limited and Moon Limited, that will be 70,000, 75,000 plus 45,500. We have 1,20,500, and after deduction we will get 9,500. Since purchase consideration is more than the share capital of Sun Limited and Moon Limited, hence general reserve of Sun Limited will be 4,200. Profit and loss account of Sun Limited and Moon Limited, that will be 800 plus 4,500, that will be 5,300. So the total will be 9,500. Then we deduct the reduced to the extent of excess of purchase consideration, that will be 9,500 over share capital of Sun Limited and Moon Limited. So, in the balance to be shown in the balance sheet, that will be nil. Same as like we have our second example, which you need to solve at your home. Here is A Limited and B Limited. First of all, we pass the general entries in the case of transfer company. When you see that in the case of transferee, the entry will be reversed. That means realization account debit to all the assets like goodwill, freehold property, plant and machinery, stock, debtors, bank. In the case of liability, so the entry will be creditor account debit, bill payable account debit to realization account. Next one is two for equity share capital account debit, general reserve account debit, profit and loss account debit to equity share capital account. Then we have C limited account debit to realization account. Then we have share in C limited account debit to C limited account. Then the entry will be equity shareholder account debit to shares in C limited. So in the last, we will calculate the profit on realization, that will be 83,300, and from that we deduct 3,300. So we get the amount of 80,000, then we deduct the liability from it, that will be 80,000. So at the end, we have no profit and no loss. When we need to pass the general entry in the B Limited, that will be the transfer company. So the entry will be realization account debit to all its asset like goodwill, plant and machinery, stock, debtors, bank, and the amount will be the book value which is given in the question. Next one is creditor to realization, as we have only one liability in this. So we have shown in only the one liability to realization account. Next one is our equity share capital, general reserve and profit and loss, that will be transferred to equity shareholder account. Next entry will be the C limited to realization account. Then we have the share in C limited to C limited at the time of purchase consideration. And then we have the equity shareholder account debit to shares in C limited at the time of final payment to equity shareholder. In this company, we have 50,000, 52,000, then we deduct 2,000 from it, and then we deduct the liability from it. So here is also no profit, no loss. Now we have the C limited, that will be the transferee company. So now the entry will be passed like business purchase account debit to liquidator of A limited and to liquidator of B limited. Next one is to calculate the goodwill account debit, freehold premises account debit, plant and machinery account debit, stock account debit, debtors account debit, bank account debit, to creditors account, to bill payable account, to business purchase account. And the last entry which we need to pass is the liquidator of A limited account debit, liquidator of B limited account debit to equity share capital account. Now there is a balance sheet after amalgamation. That means when we are added both the companies, then we need to make a one balance sheet. So in the liability side, we have share capital. 13,000 shares of rupees 10 each, that will be 1,30,000. Then we have reserve and surplus current liabilities like bill payable and creditors. Then we have fixed asset, goodwill, freehold property, plant and machinery. Then we have current asset, stock, sundry debtors, cash at bank. Here you can see there are working notes also. From this uh, you can take help for solving the question. As such, you have another illustration you need to solve. So first of all, you need to pass the journal entries to the transferor company account. Then you need to pass the transferee company account general entries. Then you need to make the balance sheet. So like this, we have another illustration which you can solve this at your home. There are multiple illustrations there is the same process for every illustration. Just you need to check this and you need to try to solve it. You have working notes also, you have proper solution for it. So basically this is all you have in numericals. Let's try to solve one more numerical with the additional information like this one, 14.9. Here is a balance sheet of A and B Limited as on 31st March 2021. We have the liability side and asset side of both the companies, A Limited and B Limited. And we have some additional information that A Limited and B Limited agreed to amalgamate and to form C Limited on the following consideration. So first additional information will be for A Limited, that the allotment of 6 lakh shares of rupee 1 each and payment of 1,60,000 in cash and discharge of debenture at par. And second one is for B Limited, that the allotment of rupees 3 lakh shares fully paid up of rupees 1 each and payment of rupees 40,000 in cash. Next one is the new company makes the public issue, that will be 3 lakh shares of rupee 1 each. The formation expenses amounted to rupees 4,000. Next one, they asked us to maintain and prepare the account of the books of A Limited, B Limited, and pass the necessary general entries for the C Limited. So first of all, we need to calculate the purchase consideration, and the purchase consideration is in the form of shares and cash. So for A Limited, shares will be for 6 lakh and for B Limited 3 lakh. Cash for A Limited 1,60,000 and for B Limited 40,000. So the total purchase consideration of A Limited, that will be 7,60,000 and for B Limited 3,40,000. Next one, we need to make the ledger in the books of A Limited realization account. So first of all, we need to take the goodwill, then land, stock, debtors, bill receivable, and cash. In the liabilities side, we have the debentures, creditors, then C Limited, then equity shareholders. So the total of both the sides will be 16 lakh 70,000. Next account we will make is C Limited account. So in this case, to realization account, we will have the amount of 7 lakh 60,000. And in this particular second case, we have the equity share in C Limited that will be 6 lakh. So by bank, the amount will be the adjusted amount that will be 1 lakh 60,000. Next one is for equity shareholder account. That means we need to make the equity shareholder account. So first of all, we take the equity share in C Limited company that will be rupees 6 lakh. Then bank account that will be 1 lakh 60,000. We have already calculated above. Then we have the equity share capital that will also 6 lakh. Then we have profit and loss account 80,000. Then we have general reserve 1 lakh 80,000. And to realization account, we have rupees 1 lakh. And the total of the amount will be 8 lakh 60,000. So, in the case of ledger, in the books of B Limited, realization account will be two goodwill account, two land and building account, two stock account, two debtors account, two bill receivable account, two cash account. So next one, in the creditor side, in the liability side, we have creditors, C Limited, for which we have purchased. Then we have the equity share holders that will be 1 lakh 72,000. So the total of both the sides will be 10 lakh 88,000. Next account which we need to prepare is C Limited account. So the account entries will be by equity share capital account 3 lakhs, by bank 40,000, and to realization account 3 lakh 40,000. Next one is equity shareholder account. We have two equity shares in C Limited 3 lakh, two bank 40,000, two realization account 1 lakh 72,000. In the buy side, we have buy equity share capital account 4 lakh, PNL account 32,000, and the general reserve we have 80,000 given in the question. So the total of both the side will be 5 lakh 12,000. So now we need to pass the necessary general entries in the case of transferee company, that is C Limited. So the first entry will be passed as business purchase account debit to liquidator of A Limited to liquidator of B Limited. So the entry amount will be 11 lakh for the business purchase, 7 lakh 60,000 for liquidator of A Limited, and 3 lakh 40,000 for liquidator of B Limited. Second entry which we need to pass about the liabilities and for the asset. So in the asset we have land and building account debit, stock account debit, debtor account debit, bill receivable account debit, bank account debit, and in the creditor side we have 13% debenture account, creditors, business purchase, capital reserve, that will be the balancing figure. Next one is liquidator of A Limited account debit, liquidator of B Limited account debit, and that the amount will be transferred to equity share capital account and to bank account for the purchase consideration paid. Next entry will be passed for the debentures, that 13% debentures account debit to bank account because the payment has been made for the debentures, that will be 1,50,000. Next one is preliminary expenses account debit to bank account, that will be the expenses which are paid 4,000. Then bank account debit to share application and allotment 3 lakh. Then share application and allotment account debit to share capital account, that will also be 3 lakh. So this kind you need to solve all the question. Here some keywords you are having like asset purchase, business purchase, liabilities. Liabilities consist of trade creditors, bill payable, debentures, loans, banks, overdraft, outstanding expenses, provident fund, pension fund, taxation provision, workmen profit sharing fund, workmen saving bank account. Then we have the trade liabilities for the creditors and bill payable. Then we have general reserve, and then we have different provisions like a provision for depreciation, provision for doubtful debt. This kind you can check all the illustration which are given to you, and you can try these at your home. So this is your unit of the amalgamation. You have multiple illustrations and questions given in this particular unit. So now we will discuss our next unit, which is related to amalgamation and absorption. That unit also consists of multiple illustrations and numerical. So here we have the our next unit of this block, that will be the for block 4. Here we have internal reconstruction. That means when the company reconstructed itself internally and not from the externally. Means a particular company have changes done, but these are done internally, and there is no role for the external entry or for the external exit or for the external consolidation. There is no role of any other thing. So in this particular unit, we need to study about the objective of this particular unit. Then we need to discuss the introduction, meaning and objectives of internal reconstruction. Then there are some steps involved in the internal reconstruction. Then there are various methods or modes of internal reconstruction and accounting procedures. So first of all, we will discuss the objectives. That first of all, we need to understand the concept of internal reconstruction. Then we have to state the objectives of internal reconstruction. Then we need to discuss the methods of internal reconstruction and the accounting entries in case of internal reconstruction. Then what are the steps involved in the internal reconstruction? Then the procedure for reducing the share capital if there is any kind of requirement. So first of all, in the introduction, there are two types of reconstruction. That means a particular company can reconstruct itself, and there are two types of reconstruction. So reconstruction basically means to reorganize or reconstitute a financial structure of the existing company. And here we have the two methods, one is external and one is internal. So the external reconstruction means that a particular new company is formed which take over the business of the existing company. The thing which we have already studied in the last unit. So like that, we have that particular thing will be the external reconstruction. That means two companies dissolve their actual entity and they form the new company that will be known for the external reconstruction. Whereas internal reconstruction, it means to reduce the share capital to cancel any paid up share capital which is lost or unrepresented by available assets. So this is done to write off the past accumulated loss of the company if there is any. So first of all, we need to understand the meaning and objective of internal reconstruction. So in the internal reconstruction, neither any company is liquidated nor any new company is formed. So only company internal form is changed by alteration or reduction of share capital of a particular company. This scheme of capital reduction is beneficial for a company having huge accumulated losses and whose assets are overvalued. That means the losses are over and the assets, sorry, the losses are huge and the assets are overvalued from their actual value. So the main objective of internal reconstruction is to eliminate the fictitious asset of a particular company such as preliminary expenses, discount on issue of shares, then to reduce the share capital of the company and to bring it to its real worth. Third point will be creating confidence among the shareholder by providing them fair return on their true investment. Next one is to present the true and fair view of the company's financial position. Now, here are some kind of steps involved in internal reconstruction. So, basically, first of all, the capital reduction, it involves the sacrifice on the part of the shareholder, debenture holder, creditors, and they have to utilize the amount foregone by them to write off losses and also scale down assets to their real values. Just give me 2 minutes. So in this particular step, first step will be the goodwill. So in the case of a particular company which lost capital and appearance of goodwill in the balance sheet does not make any sense, so this item is usually written off. Second one is other items like discount on issue of shares, debentures, capital issue expense, preliminary expenses are only deferred expenses, and it is not healthy to keep such items in the balance sheet. So, such items are also written off on reorganization. When we are doing the internal reorganization, at that time we will return off. Next point will be any debit balance in profit and loss account represent accumulated losses, and such losses will be written off as part of capital reorganization. Next point will be asset with inflated book value. Some of the asset may be appearing at reasonable book values either due to insufficient depreciation or due to technological changes. So such asset must be brought down to realistic values. Now, next topic will be modes or methods of internal reconstruction. So there are two methods for internal reconstruction. First of all, alteration in share capital, and second one will be the reduction in share capital. So first we will discuss the alteration in share capital. In the case of share capital alteration, it involves those cases which do not require any approval from the court. So here are some different alteration which a particular company can carry out if the article of the company gives the authority. So the first one will be to increase the share capital. So if the share capital of a particular company can be increased only by issue of new shares, and if there is a permission given in the article of the company. Next one is to consolidate of share. It is done by consolidation of existing shares of a smaller denomination into shares of higher denomination. For example, A Limited having a share capital of rupees 30 lakh that will be divided into 3 lakh shares of rupees 10 each, and they resolved to consolidated the share into 30,000 shares of rupees 10 each. So here we have the general entries that will be passed. Share capital account debit to share capital account. So the entry will be passed for the 30 lakh. So as such, the amount of share capital remains the same and the number of shares is reduced with the consolidation. Our third point is subdivision of shares. So in this method, the existing shares of higher denomination are subdivided into the shares of a smaller denomination. And if the shares are partly paid up, then care must be taken that the ratio between the face value and the paid up value should remain the same. Here we have the example for it that A Limited having a share capital of rupees 30 lakh that will be divided into 30,000 share of rupees 100 each. That will be resolved to subdivide the shares into 3 lakh shares of rupees 10 each. So we have the general entry for it that will be share capital account debit 30 lakh to share capital account at rupees 10. Next one is to cancel the unissued share. So basically, in this method, the shares which have not been subscribed are cancelled, which leads to the decrease in the misissued capital or unissued capital. The company without the sanction of the court cannot cancel the unpaid amount on the already issued shares. Next point will be conversion of shares into stock. That means if we convert a particular share into stock, or the stock is reconverted into fully paid shares. So here we have the example that A Limited converts its 3 lakh share of rupees 10 each into equity stock of rupees 30 lakh. So the general entry will be equity share capital account debit to equity stock account, that will be 30 lakh. So in all the above cases, we need to have the special resolution passed for the alteration of share capital and any sanction from the court which is not required. Our next point is reduction of share capital. That means if we want to reduce the share capital, so the reduction of capital can be carried out by the company according to the provision of section 100 to 105 of the Companies Act. So the reduction of capital can only be made if it is mentioned in the articles of the company and a special resolution is passed to the effect. Further, the scheme of reconstruction should be approved by the court and the sanction of the court should be maintained, and the scheme is passed by the court only if it thinks fit and consent of the creditors is obtained or there is any kind of claim are settled. So the capital reduction can take place in any of the three forms. First form will be the reducing the liability in respect of uncalled amount of share, or second one will be if you need to pay off the unpaid capital which is in excess of the need of the company. That means you have the unpaid capital which a particular company does not require. Third one will be the cancellation of paid up capital which is already lost or not represented by the available asset. That means you need to cancel it. So the creditor consent is required in the first 2 points and not in the third point, because their interests are affected by the reduction and not by the cancelling. Now we have the procedure for reducing the share capital. So first of all, a particular company cannot reduce its share capital unless it is authorized by its article of association. If the articles does not permit capital reduction, they may be altered by special resolution which will be passed in the general meeting of a particular company to enable the company to reduce its share capital. Second one is to, if the company wants to reduce the capital, they have to pass the special resolution. Third one is if the company must apply to the court for an order that will be confirming the capital reduction. So the court must look after the interest of creditors and shareholders before giving an order confirming the capital reduction. The court may make an order confirming the capital reduction on such terms and condition as it thinks proper. If it is satisfied that every creditor of the company that entitles to object capital reduction has consented to the reduction or his debt has been discharged or secured by the company. The court may also order the company to add the words like and reduced to the name of the company for such period as it deems fit. The court may also order the company to publish reason for reduction and all other information in regard thereto for public information. Next one is the order of the court confirming the reduction must be produced before the registrar, and the certified copy of the order and of the minutes of reduction should be filed with the registrar for registration. Next one, we have the cases in which the procedure of reduction of capital is not called for. That means there you cannot do the reduction of capital. First case will be the where the redeemable preference shares are reduced in accordance with the provision of Section 80. Section 80 is defined in the Companies Act. Second one, where any shares are forfeited for non-payment of calls. That means a subscriber did not pay the particular call money, and after that we forfeit his or her shares. Third one is where there is surrender of share or a gift is made to a company of its own share. That means a particular company surrender as a gift. Fourth one is where the nominal share capital of a company is reduced by cancelling any shares which have not taken or agreed to be taken by any person. Next one is accounting procedure under various circumstances. First case will be reducing the liability in respect of uncalled amount of shares. Here we have the example to understand it, that capital of A Limited, which consists 10,000 share of 10 each and 8 paid up, is now reduced to 10,000 shares of 8 paid up. Here we have the general entry for it, that equity share capital account debit to equity share capital account, that will be 80,000. So the shareholder benefit because they are not required to pay rupees 2 in future. Case 2 will be paying off the unpaid capital which is in excess of the needs of the company. Then we have the company which finds that it has excess capital, it may reduce it by returning the excess capital to its shareholder. The entries are as follows. First entry which we need to pass, that a share capital account debit to shareholder account, and the second entry will be shareholder account debit to bank because the amount will be transferred to bank. Our third case for the cancellation, the paid up capital which is already lost or not represented by the available asset. So when a company suffer losses continuously, the asset side of the balance sheet contains the accumulated losses and the unwritten balances of the fictitious assets like preliminary expenses, and some other assets like, are also shown at the overvalued figures because in the absence of profit proper provision are not made. In such a case company can't enjoy goodwill also. So in this case the scheme of capital reduction is adopted to show the capital at its real worth, and the amount so available through capital reduction is utilized to write off all the intangible assets, fictitious asset and other overvalued asset. Next one is to following entries we need to pass for reducing the amount of paid up share capital. The entry we need to pass is share capital account debit to reconstruction account. If the losses have accumulated of such an extent that the portion of borrowed capital is also lost, then the debenture holder and the creditor will also sacrifice. So the general entry will be debenture account debit, creditors account debit to reconstruction account. Then utilizing the amount of reconstruction account for writing off past losses, fictitious and intangible asset, excess value of other assets. So the entry which we need to pass is reconstruction account debit to goodwill account to accumulated losses account to excess portion of asset account to unrecorded liability account. And if the reconstruction still shows the credit balance, then it will be transferred to the capital reserve account. So the entry will be passed as reconstruction account debit to capital reserve account. So here we have the illustration. We have a balance sheet of A Limited as on 31st March 2021. We have equity and liabilities and we have the asset. So the company adopted the following scheme of reconstruction. The intangible assets are to be eliminated. First thing. Second thing, expenses for reconstruction amounted to rupees 2,000. Third, machinery is to be depreciated by 50%. Value of building is to be increased by 50,000. Debenture holder took over the stock and debtors in full satisfaction of their claim. Then preference shares to be reduced to rupees 75 per share, fully paid up, and equity share of rupees 40. Now we need to pass the general entry of A Limited. First entry will be the 6% preference share account debit, and the amount will be 2000 preference share of rupees 100 each, so it will be 2 lakh. Then 6% preference share capital account, the amount will be 2000 multiplied by 75, so the amount will be 1,50,000. Then two reconstruction account, so the amount will be 5,000 for it. So this entry will be passed for the reduction of preference share capital to rupees 75 fully paid out. Next entry for equity share capital. So equity share capital account debit, and the whole amount of equity share will be, we need to write here, that will be 4,000 multiplied by 100, that will be 4 lakh. Then two equity share capital account, 4,000 multiplied by 40, that will be 1,60,000. Then two reconstruction account, that will be 2,40,000. Next one is 5% debentures account debit, cost rupees 1 lakh. Then to stock account, to debtors account, and to reconstruction account. For the debenture holder who accepted stock debtors in full satisfaction of their claim, at that time we will pass this kind of entry. Next one is building account debit to reconstruction. As there is an increased value of the building is recorded, that will be rupees 50,000. Next entry will be reconstruction account debit to bank account, to statement of profit and loss account, to plant and machinery account, to goodwill account, to capital reserve account, and the amount of capital reserve will be balancing figure. Here we have the reconstruction account which we need to pay. There is a debit side on the left side and there is a credit side on the right side. So on the debit side we will take the bank 2000, to statement of profit and loss account 2,20,000, then to plant and machinery 1 lakh, then to building account 20,000, to capital reserve account 8,000. Then we have the credit side in which we need to write by 6% preference share capital account 50,000, by equity share capital account 2,40,000, by 5% debenture account 10,000, by building account 50,000, and the total of both the sides after the balancing figure, that will be 3,50,000. After that, we need to make the balance sheet of A Limited as on 31st March 2018. So here we have the balance sheet that we need to make the equity and liability. First of all, we will write the shareholders fund, in which we need to add the share capital, reserve and surplus, that is capital reserve. Then we have non-current liabilities like long-term borrowing, bank loan 50,000. Then we have current liability, trade payable, creditors 1 lakh. Then we have assets, non-current assets like fixed asset, tangible. Then we have current assets, cash and cash equivalents. Here we have the notes also to calculate the whole amount, like share capital, authorized, issued, subscribed and fully paid up capital 2006% preference share of rupees 75 each, that will cost 1,50,000. Then 4,000 equity share of rupees 40 each, that will cost 1,60,000, and the total amount will be 3,10,000. Second one is fixed asset, that is tangible, that one is building and plant and machinery 3,50,000 and 1 lakh. Next one is, as mostly scheme of internal reconstruction are not confirmed to the reduction of capital only, therefore it is better to open reconstruction account in the place of capital reduction account. The same way we have a balance sheet of Janvi Limited, and here we have some additional information that the company proved unsuccessful and the following scheme of reconstruction is passed. First of all, preference shares be reduced to an equal number of fully paid up shares of rupees 6 each. Second, equity shares to be reduced by rupees 6 each through total number of equity share will remain the same. Third point, they said to us the rate of interest on debentures is to be increased to 11%. and the debenture holders surrender their existing debentures of rupees 100 each and exchange the same for fresh debentures of rupees 75 each. Next one is that the amount thus available for the reduction of the asset is apportioned as follows. That means discuss on issue of shares and profit and loss account to be written of entirely rupees 50,000 of the building, rupees 20,000 of the machinery, rupees 6,000 of the furniture, and the balance available to be written of debtors. So here now we need to pass the general entries for it. The first entry will be for preference share capital. So 8% preference share capital rupees 10, and now we need to do it for rupees 6. So 8% preference share capital account debit to 8% preference share capital of rupees 6, and the amount which is reduced that will be gone to reconstruction or capital reduction of rupees 16,000. Next entry for equity share capital account rupees 1,80,000 to reconstruction or capital reduction, because the equity share also of rupees 6 each from now onwards. Next one is for debenture holders. They said to us to increase the debentures. So from 8% debentures, we will now have 11% debentures. So 8% debentures account debit 1 lakh to 11% debentures account 75,000, and to reconstruction or capital reduction as being reduction of 8% debenture of rupees 100 each to 11% debenture of rupees 75 each. That means the price of the debenture will be reduced, but the interest will be increased. That means we need to pay interest more to the debenture holders. Next entry will be passed reconstruction or capital reduction account debit to discount on issue of shares, to profit and loss account, to building account, to machinery account, to furniture account, to debtors account, being write off fictitious asset and depreciation on various asset. Next, we need to make the balance sheet. Equity shareholders, in which we have share capital 1,44,000. There is no reserve and surplus in this question. Then we have non-current liabilities, long-term borrowing, that will be 11% debenture of rupees 75 each, 75,000. Then we have trade payables of rupees 60,000. Then we have the asset value, non-current asset, fixed assets, that will be the tangible 2,59,000. Then we have the current asset, that will be the trade receivable of rupees 20,000, and the total amount of both the side will be 2,79,000. Here you have the notes also for making this particular balance sheet. That means if we are saying the tangible asset, so directly we mention here 2,59,000, but we add the amount of building, machinery, furniture, then this amount will be shown. Uh, Same is for the shares and subscription. We already showed 1,44,000, but 1,44,000 included preference shares and equity shares after the reduction. In the same way, we have the other illustration, that will be, you need to do it at your home. Here are multiple illustration which you need to perform at your home, practice at your home, sorry. So basically, this is our 15th unit. Now again, I will tell you some kind of definitions or basic concepts of amalgamation and companies, so that you can connect if you did not attend the last class. This will be helpful for you, the definitions and the basic concept of amalgamation of companies. That first of all, we have the term reconstruction. So basically, reconstruction is said to us, it is a combination of the companies, but merely to reorganize a particular company which has suffered huge losses which are to be written off. That will be known as reconstruction. There are two kinds of reconstruction. First one is external reconstruction, and it is different from the amalgamation. So, in the case of external reconstruction, existing companies is wound up by selling its business to newly formed company which is generally similar named or owned by the same shareholders. That will be known as external reconstruction. Next one is internal reconstruction. So basically, it is a different form of business combination. In this particular reconstruction, the company continued with its legal entity and is only internally reorganized and rearranged, and reduction of share capital is done. So the internal reconstruction, the share capital is reduced to its real worth, and the same amount is used to eliminate the accumulated losses like fictitious assets and to written down the overvalued asset of the company. Now there is a difference between amalgamation, absorption and reconstruction. In the case of amalgamation, a particular new company is formed. In the case of absorption, no new company is formed, and in the case of reconstruction, company is reconstructed. Next one is liquidation. All the companies which go for amalgamation are liquidated. The company whose business is purchased by another company goes into liquidation in the case of absorption. Then the company which is reconstructed goes into liquidation at the time of reconstruction. Then what is the financial position of a particular company in case of amalgamation? The financial position of all the involved companies is same. In the case of absorption, the company is comparatively sound than the absorbed company. And in the case of reconstruction, old company is bad and is usually considered as a sick unit. Next one is the objective of the amalgamation is to eliminate the competition among the amalgamated companies. Next, the objective of absorption is to expand the business and to achieve the economies of large scale production. And the objective of reconstruction is to write off the accumulated losses and offering the real worth of the business to the shareholders. Next one, the position of shareholder in a new company. So the shareholder of the amalgamated companies become the shareholder of the new company. Next, the shareholder of the selling company may become the shareholder of the purchasing company. And in the case of reconstruction, most of these shareholders of the old company continues to be the shareholder of the new company with the proportionate share. Next one, here are some important terms for the amalgamation like transferor company. It is the company which is amalgamated into the other company. Transferee company, in which transferor company amalgamate. And what is amalgamation? Amalgamation is basically of two types. First one is amalgamation in the nature of merger. So here are some conditions to follow in the case of merger, that all the assets and liabilities of the transferor company become, after amalgamation, the asset and liabilities of the transferee company. Next one will be shareholding not less than 90% of the share value of the equity share of the transferor company and become equity shareholder of the transferee company by virtue of the amalgamation. Next one is the consideration for the amalgamation receivable by those equity shareholders of the transferor company who agree to become equity shareholder of the transferee company and is discharged by the transferee company wholly by the issue of equity share in the transferee company, with the exception that cash may be paid only in respect of fractional shares. Next one will be the business of the transferor company is intended to be carried on after the amalgamation by the transferee company. Then no adjustment is intended to be made to the book value of the asset and liabilities of the transferor company when they are incorporated in the financial statement of the transferee company, except the except to ensure uniformity of the accounting policies. Next one is the amalgamation in the nature of purchase. So the amalgamation in the nature of purchase is an amalgamation which does not satisfy any one or more of the five conditions stated above. And the purchase and the business purchase, if it is mentioned in the question of the that the transferee company has purchased the asset of the transferor company, it means that transferee company has acquired all the assets including cash and not the liabilities of the business of the transferor company. And if it is mentioned that the transferee company has purchased the business of the transfer company, it means that transferee company has acquired all the assets and liabilities of the transfer company. Next one is the liability and trade liabilities. The term liability includes trade creditors, bill payable, debentures, bank overdraft, outstanding expenses, pension fund, provident fund, workmen profit sharing fund, and the term trade liability include creditors, bill payable, which are so the term trade liabilities. These include creditors, bill payable, which are associated with sale, purchase of goods and services. Then we have a different methods for accounting for amalgamation. First one is the pulling of interest method and the purchase method, which we are already discussed in the previous lectures. So in the case of pulling of interest method, we will use the accounting standard, that will be the accounting standard 5, and we will check the net profit and loss for the period, prior period items, and what are the changes in the accounting policies. In the case of purchase method, under the purchase method, the transferee company accounts for the amalgamation either by incorporating the asset and liabilities at their existing carrying amounts or by allocating the consideration to individual identifiable assets and liabilities of the transfer company on the basis of their fair value at the date of amalgamation. That identifiable assets and liabilities may include asset and liabilities which are not recorded in the financial statement of the transfer company. They give us example also like planned employee termination and planned reallocation cost. Next one is treatment of reserves on amalgamation. The amalgamation, at the time of amalgamation, the reserves will be added if there is any, and we need to check whether they are the prior the amalgamation or post the amalgamation, and which company is having how much reserve. According to that, we will treat it. Next one is the treatment of goodwill that will be arising on amalgamation. So the particular goodwill, which is frequently difficult to estimate its useful life with a reasonable certainty, but it will be considered appropriate to amortize goodwill over a period not exceeding 5 years unless somewhat longer period can be justified. Then what we will do, the balance of P&L account, that will be the profit and loss account. So in the case of merger, the balance of P&L account appearing in the financial statement of the transfer company is agreed with the corresponding balance appearing in the financial statement of the transferee company. Alternatively, it is transferred to the general reserve if there is any. Then, in the case of amalgamation in the nature of purchase, the balance of the profit and loss account appearing in the financial statements of the transfer company, whether debit or credit losses its identity. Next one is purchase consideration. It is the amount which is paid by the transferee company for the purchase of the business of the transfer company. Like lump sum payment method, in which we paid all the amount in one go. Then net asset method, where we have different points like value of only those asset is included which are acquired by the transferee company. Then value of only those liabilities will be deducted which have been taken over by the transferee company. Then cash balance is normally included in asset, but if it is not taken over, it will not be included. Then goodwill is an intangible but valuable asset, as such is included in asset. Then fictitious asset not written off should not be added. Then actually this method is used only for net payment, cannot be adopted. Next one is net payment method. This method is for calculation by adding the various payments in the form of shares, securities, cash made by the transferee company. Then no amount of liabilities is deducted even if these are assumed by the purchasing company. Then purchase consideration is the total of all the payments, whether in shares, securities, or cash. Here we have example also. Then X Limited agrees to give for every 10 shares of Y Limited, 15 shares of 10 each, 8 paid up. Then X Limited agreed to pay 15,000 cash to discharge the creditors. So the purchase consideration is calculated like shareholder of Y Limited will get 6,000 multiplied by 15 divided by 10 is equal to 9,000 shares of rupees 10 each, 8 paid up, that will be 72,000. Then cash paid 15,000. So the total purchase consideration will be 87,000. Here are some points to be kept in mind for the calculation, that the asset and liabilities taken over by the transferee company are not to be considered. The payment made by the transferee company for the shareholder, whether in cash or share, must be taken in account. If the debentures and creditors are taken over by the transferee company and subsequent discharge, then such amount should not be deducted from the purchase consideration. Next one is intrinsic method, value method. This method is just the extension of net asset method. So in this, purchase consideration is required to be calculated on the basis of intrinsic value of share, and the intrinsic value of share is calculated by dividing the net asset value available for equity shareholders by the number of equity shares, and this value determines the ratio of exchange of shares between the transferor and the transferor company. Suppose A Limited and B Limited are two companies carrying on the business in the same line of activity. Their capital is 6 lakh and 2 lakh. Value of share will be rupees 10. So these two companies decided to amalgamate in C Limited. If each share of A Limited and B Limited is valued rupees 15 and 25 per share for the purpose of amalgamation, the purchase consideration will be for A Limited 60,000 share at rupees 15 each, so the amount will be 9 lakh, and for the B Limited 20,000 shares of rupees 25 each, so the amount will be 5 lakh. So like this we need to solve our all questions. And here you also have some keywords like amalgamation, absorption, external reconstruction, internal reconstruction, and purchase consideration. So this is your block 4 which we covered today, in which we read about amalgamation, absorption, external reconstruction, internal reconstruction. These are the important points for your exam point of view. If you have any kind of query about these 3 units, you may ask.
No, ma, there is no any query.
Okay. So I recommend you to practice all the illustration which is given to you in this particular.
Oh,
In each unit, you have multiple examples or illustrations for the numerical questions. So please try to do that at your home and practice at your home. So it will be much helpful for you. And if there is any query when you solve it, then you may ask from me in the next lecture. Okay.
Okay, ma.
Okay, so we will done for today. Today we have completed our fourth block. Okay,
Yeah.
thank you so much. Have a great day.
Okay. Okay, thanks you, ma. So much. You have also have a great day.